When you hear about the Nasdaq, you're thinking about the company Nasdaq Inc, aren't you? The one that's got a market cap of almost 27 billion, that generates over 6 billion in revenue annually and goes by the ticker NDAQ, right? Oh, you're not? I'm sorry, then you're probably thinking about the index that's up there with the Dow Jones or the S&P 500 or Russell, one of the big indices that you always see talked about in the news. Unless that's not... Oh, I'm wrong again. Oh, okay, I'm sorry. So I guess all that's left is that you're thinking about the Nasdaq Stock Exchange. That's where thousands of companies are traded publicly over a complex computer network that features 250,000 miles of fiber optic lines. That's the equivalent of going to the moon or driving around Earth 10 times. That's a ton of cable. Wait, what are you thinking about and what am I talking about? Hey folks, I'm Daniel, back with another investing video. The Nasdaq is a crazy story and I'm thrilled to bring it to you. It's a one-of-a-kind American success story that starts out kind of boring with a regulatory agency managed by the SEC and then explodes into the scene, hitting home run after home run. Stick with me as I lay the foundation here. You're not going to want to miss it as I paint the picture of the full scope of the Nasdaq story. You might have been able to tell from the beginning that the Nasdaq, as it's used in everyday investing language, is basically three things that you need to know. It's a company, it's a stock exchange, and it's an index. That's it. There's a ton more, but I'm just going to cover the basics in this video. I'm going to cover them in that order on purpose. It all starts with a company creating a product, which is the exchange. That product, over a fairly short period of time, explodes into something so massive that everyone starts to use it as a benchmark for the whole stock market. So let's start with the basics. Nasdaq stands for National Association of Securities Dealers Automated Quotations. Before we move on, you can get a ton of info just from this name, so stick with me here. The National Association of Security Dealers, or NASD, was founded as a result of legislation and a joint effort between Congress and the SEC during the Great Depression. The NASD was a private association that provided financial regulatory services. It's incredibly dull, so I'm not going to spend much time on it. Basically, they operated under the supervision of the SEC before they became the FINRA. Okay, so the NASD started in '38, but it wasn't until 33 years later in 1971, at the urging of the SEC, that the NASD founded the Nasdaq in New York City. They wanted to create the world's first electronically run stock market that was open and transparent for everyone. It didn't start as something on which trades could be executed. Instead, it provided automated quotations on stocks, and their focus wasn't even on the big blue chip companies. They did over the counter, which just means companies not listed on the exchange. So now that we know NASD was the agency and that automated quotations was their goal, that's how we end up with Nasdaq. This automation eliminated the work necessary to provide a quote, which reduced the need for as much manpower. So instead of the boots on the ground in this huge floor at the stock exchange, anyone with access to their system could do business. This efficiency gain resulted in lowering the gap between bid and ask prices. Less profit for the brokers resulted in some unhappy campers, but there was no stopping this innovative process for quoting stocks. You might think of it as this fancy screen in New York with ticker prices going by, but the quotes were done on a terminal that looked like this. The president of the NASD at the time described it as an electronic bulletin board, and you can even see what it looked like on the Nasdaq website. You just push a button and up on the screen pops a quote for the current bids and offers all over the country. I'll get back to this in a moment when I go over the exchange, but let's stick with the company for now. Fast forward to today and we're looking at a company extremely well diversified beyond just a stock exchange. Their biggest source of revenue is still running the exchange, which accounts for 35% of the company revenue. But they also are a research and analytics company similar to Standard & Poor's or Morgan Stanley, providing financial information and research services that make up another 30% of their business. They offer additional listing services, investor relations, and governance products that make up 20% of their book of business, and then the last 15% is through running other exchanges throughout the world and providing financial compliance services. So they have a huge presence in the Nordics, Baltics, and Latin America. This makes sense though because it worked here, why not elsewhere? So how's business for Nasdaq Inc? In 2005, they went public. As I mentioned earlier, their market cap is nearly 27 billion. If you've invested in NDAQ 10 years ago, you'd be pretty happy to see your portfolio look like this. About 5 years ago, NDAQ was neck and neck with the S&P 500, but it's created some separation and only time will tell if it will keep up this pace of growth. The company has done so well that it's actually in the S&P 500 index and it's classified as a financial holding. If you own SPY, VOO, or any other S&P 500 index fund, you're invested in NDAQ. You are a shareholder of Nasdaq Inc. So that's a broad overview of the company, but what about the index and what about the stock exchange? I'll get to the index in a moment, but first the exchange. Their innovative approach to running an exchange is the reason that the Nasdaq, the company, took off. Remember this thing? It was used to provide quotes for traders. They shifted away from the floor-based trading models. They set up one of the world's first data centers for trading. The floor-based trading model for the New York Stock Exchange resulted in investors seeing a ticker tape of historic trades after the fact. Nasdaq built an exchange where the bid-ask quotes could be updated electronically in real time. This was huge because it eliminated the advantages of a floor-based market. If you were on the trading floor, you had the physical presence that gave you the ability to act quickly on new information before anyone else. The Nasdaq Stock Exchange changed all that. Instead of having to be on the floor, anyone that was connected to their system could compete. All subscribers could see every single quote uniformly across all networks, further incentivizing competition. Here's how that worked out. The spread absolutely plummeted. The spread is the gap between what someone is willing to pay to buy a share and what someone is asking for to sell the share. The difference is usually profit. This also resulted in the average daily volume of shares exploding. By 1991, the Nasdaq accounted for 46% of all security transactions. Besides the innovative aspect of electronic quoting, why would a company choose the Nasdaq Stock Exchange over the New York Stock Exchange? To start, the Nasdaq charges less for a company to list on the exchange. Take a look here. It's $50,000 to get started, $45,000 to $81,000 annually to maintain your listing, versus the NYSE, you need 3 times that at $150,000 to get started, and anywhere from $71,000 up to nearly $300,000. We're talking double or triple the cost. They also have a reputation for requiring less red tape, so if you're a smaller to medium-sized company that wants to go public, there's an immediate incentive to go public on an exchange that makes your life easier and costs less and is completely accessible electronically with no need to physically be present. This is capitalism 101, and it worked. The exchange attracted innovative tech startups, and as these tech firms started to take off, it only increased the prestige and attraction of the exchange itself. We're talking Intel in '71, Apple in 1980, Microsoft in 1986. Shortly after, in 1990, Cisco followed suit. 7 years later, in 1997, Amazon went public. They continued with their innovation. In 1998, they were the first exchange to offer online trading. 2004, the Google IPO took place. In a roughly 34-year period, they had an incredible run with these tech behemoths just taking off, and they were racing to capture this momentum. Right after the Google IPO in 2004, Nasdaq converts from being an industry-owned, semi-private organization to going public and being a company whose shares were accessible to you and me. The Nasdaq exchange is the second largest in the world with a 16.24 trillion market cap of companies listed. This compares to 22.77 trillion of market cap companies on the NYSE. In 50 years, to be the second largest in the world is just breathtaking. Not only that, but they also complete the most trades per day of any exchange in the world. In a matter of 50 years, you have this innovative concept regarding how to quote stocks that quickly morphs into this online trading juggernaut that has evolved into a massive exchange with thousands of companies listed. Those companies represent a massive part of the market and the economy as a whole, so it only makes sense to track how these huge group of companies are doing, and that's the Nasdaq Composite Index. So when you're looking at financial news and they say that the S&P is this and the Dow is this and the Nasdaq is that, they're not talking about Nasdaq the company, they're talking about Nasdaq the Composite Index. Not every single product on the exchange is eligible to be on the index, as they do have some exclusions, but it's most of them. The most notable exclusions are ETFs and derivatives. To understand an index, if you're familiar with the S&P 500, it's the 500 largest publicly traded companies in the US. That's an index that is licensed by Standard & Poor's, hence the name S&P 500. The Nasdaq is like that. The Nasdaq Composite Index is made up of more than 3,000 stocks listed on the Nasdaq Stock Exchange, and it's a benchmark owned and licensed by Nasdaq the company. You can buy mutual funds and ETFs that are indexed to the Nasdaq Composite Index, ones like these from Fidelity. You'll usually hear that it's tech heavy, but you don't often hear just how heavy it is. Over half of the index is weighted for tech, which is 3 times anything else in the index. 5 mega cap companies make up more than 40% of the index. Mega cap in this sense means it has a market cap of over 200 billion. So these are companies like Microsoft, Apple, Amazon, Nvidia, and Google. If one of these companies has a bad day, the index has a really bad day. What does a bad day look like with the index? Over the past 50 years, we've seen 15 down years. If you own a Nasdaq Composite Index fund, historically 3 out of 10 years will be down. Sometimes it will dip a few points and not really be a big deal, but other times it will be a race to the bottom. I count 9 times in the past 50 years that it's dropped over 10%, 7 times that it's dropped over 20%, 6 times that it's dropped over 30%, and 1 time that it's dropped over 40%. This is not an index to invest in if you are easily spooked or nearing a retirement and can't afford to see a massive drop. If your investment style is to panic the minute the market drops, sell everything and go buy gold or hide it under your mattress, I would run from this index. But on the flip side, in the past 50 years, it's exceeded 10% returns 30 times. That means 6 out of 10 years will be a good year or better. It exceeds 20% returns 11 times. It's cracked the 30% return mark 5 times. It's passed 40% 3 times that it's hit a whopping 50% return, and once that it reached 85%. That 85% was definitely a bubble. In fact, it was the dot-com bubble, and the following 3 years proved it with losses between 20 and 40%. Put simply, this is a volatile fund that goes up more than it goes down, and over the past half century, its average annual return has been around 12.7%. What's interesting about the index is that its second highest weighting after technology, which accounts for over half of the index, is consumer services at 16% and consumer goods at almost 9%. Healthcare is at 7%, financials at 7%, and industrials at 5%. After that, the weightings for oil, gas, utilities, and telecommunications or basic materials just tapers off to 1% or less. Inflation plays a huge role with this index because when money is cheap, these tech companies can borrow for next to nothing to invest, innovate, and hire for expansion. But when inflation increases and the Fed raises the interest rates, these companies have had to do some belt tightening and they tend to pull back. In the same way, if the consumer services and consumer goods areas of the economies contract, so will the Nasdaq with its consumer-oriented companies carrying an approximate 25% weighting. So that is a big picture overview of the Nasdaq as a company, the exchange, and the composite index. I hope you learned something and that you found it interesting. Leave a comment if so. If you got just one thing out of it, that's good enough for me. If you like content like this, check out some of my other investing videos. Until next time.